Despite slowing annual growth, quarterly growth of prime global residential rents rose to 1.1% in the second quarter. To tell us how it is in Asia Pacific, we have Christine Lee from Knight Frank. Christine, what has changed in the Asia Pacific prime rental rates recently?
Yeah, recently we have seen a very strong rental growth, particularly in the second quarter of this year. This is despite the earlier slowdown we have seen in the last 12 months. Although overall we are still seeing about 8.4% growth in the last 12 months, particularly from some of the gateway cities such as Melbourne, Sydney, Gold Coast in Australia, Auckland in New Zealand, and Tokyo in Japan. These markets have recorded double-digit growth in the last 12 months, and that's been driven by the structural changes that has impacted the investment demand, but from the rental perspective, there's still very strong rental demand.
Can you explain what drives the strong rental growth, just as you've mentioned, in Tokyo compared with, let's say, Hong Kong and Singapore?
For Tokyo properties, I think that's also because of the introduction of the higher tier and the bigger apartments that has spurred this relocation of many renters to these new dwellings. This is a good sign because we know that with low interest environment in Tokyo, the economy has slowly recovered from the past lows in the last 2 decades. And we are seeing an inflow of expatriates returning to Tokyo, and that has added in the demand drivers for these properties. But on the other hand, in Hong Kong, despite the rental demand from the mainland Chinese renters, we have not really seen the prime rents recovering because these renters tend to just focus on the lower to mid-tier properties in Hong Kong. So that's pretty much in the range of 40,000 to 50,000 Hong Kong dollars per month. And we are also seeing a sluggish return of the expatriates to the city, as well as the lack of new demand by the locals. In Singapore, the situation is slightly more different because we are seeing a strong, supply situation coming to the market, and that's adding pressure, downward pressure to the rental market. And as you can see, because of years of this pent-up demand, the constructions were actually playing catching up. And in the last 1 to 1.5 years, we have seen lots of supply hitting the market. And because of that, a lot of renters actually transition to permanent residence or permanent ownership. And that has resulted in the lack of rental demand in the market. And in addition, if you were to look at some of the MNCs, the tech companies, they are not really growing their footprint. So some of the expatriate demand has also disappeared because the expatriates returned home in view of the high living cost in Singapore.
And considering all these, Christine, how might the stabilization of rental growth impact investor sentiment in prime residential markets across APAC?
I think the stabilization is actually a good sign because in times of volatility, I think investors tend to stay on the sideline. But with stabilization of the rents, investors are probably more confident to enter the market, especially for longer term investment horizon. And just recently, we have seen Fed cutting interest rates bigger than the market expectation, which is a good sign that some investors may consider this opportunity to come back to the market given the lower cost of borrowing.
Thank you for joining us, Christine.
Thank you.
Once again, that was Christine Lee, Head of Research at Knight Frank Asia Pacific. For more news, visit realestateasia.com.